One of the main reasons why I started this YouTube channel in the first place was to try and help Canadians make better financial decisions, whether that be for insurance or other things. Now, here's the thing. I'm fairly well versed in the world of insurance. However, I don't understand investments very well in Canada, which is why I brought on a very special guest today, Ryan Gubic, so we can have a candid conversation about the problems about investing in Canada, where you should even start, what products to avoid and what products not to avoid, which products are the best. And I hope by the end of this video, you'll have a very firm understanding of what different types of options are available to you as a Canadian at different income levels and which one would be best. What is up, guys? For those of you new to the channel, my name is Philip Setter. I'm the founder and CEO of Affinity Life, where we've helped hundreds of Canadians find the right life insurance coverage at the right price, all from the comfort of their own home. If that sounds interesting, I'll put the link in the description and you can check it out. But without further ado, let's get right into the video.
Okay, first of all, thank you so much for even doing this for me. So, Ryan, you know me pretty well. I know you pretty well. Started the YouTube channel really on the insurance side, life insurance specifically, and just the general idea of the channel was to try and provide education for Canadians so they could make better decisions to buy life insurance or buy disability insurance, or buy any type of insurance product. But I'm an insurance advisor and I don't work in investments at all. So segregated funds, like you're familiar with them, obviously. I'm licensed to sell segregated funds. I have another video on the channel where I talked about segregated funds and why I don't think they're really a good fit for maybe 5% of the population is in that, it's actually applicable to them. So I'll give you an intro before we even start this video, but maybe if you just want to share a quick 30 seconds about yourself, how you got started in the business, some of the credentials that you have, because they're incredibly respectable. You have an entire alphabet in front of your name. You put a ton of time into learning and really improving your game. So maybe just a quick 30-second intro about yourself, how you got started and kind of what you're doing.
Yeah, thanks, Phil. I appreciate you having me
Absolutely.
So why I got started was really the huge disconnect in the financial industry. So as you said, I have a few designations behind my name. One of my values is always around continuously learning. So started at a young age. My dad worked for CRA, so I'm the son of a tax man there. So I got interested in business and taxes really young. Wanted to be an accountant. I was one of those 8-10-year-old kids that be like, "Where do you want to grow up?" I want to be an accountant.
Said no one ever.
Yeah, I can imagine how cool I was.
Except for you.
And that passion for knowledge and learning just kept on growing, right? So became a designated accountant and then wanted to learn some more. So I was like, hey, business, how does accounting and money tie into business strategy and goal setting? Let's do an MBA. That makes sense. So I was fortunate enough to do an MBA in Edinburgh, Scotland. So I had an international flavor as well, talk not just about North American business, but also Europe and Asia. And then from there, saw the big challenge, so full circle. The gap in the financial industry is there's all these products kind of floated around everybody. And then there's, a number of people that are called advisors. And I love how you said, you're an insurance advisor, you specialize in insurance. So if someone needs insurance and has challenges and problems in the area, they can call you and your team and get results. In the industry, quite often there's, individuals that will say advisors and they try and put their arms around everything. So how do you do that? And you do that in the right manner. What often quite often happens is, an individual have maybe an accountant they work with, they might have an insurance advisor they work with, they might have an investment advisor they work with, but no one's actually tying their whole financial picture together. And what happens at the end of it is they have all these statements and money floating around, and they don't have the answers to the really important questions in their life. Like, am I going to have enough one day to retire? Can I live the life I want? What happens if, A, B, C, these risks that, I've kind of hoping wouldn't happen, but really have never talked about. They're uncomfortable. You in the insurance world, right? What happens with premature death or disability or even just the really real world example of losing your job unexpectedly, right? How do you float your mortgage and your bills and your family and everything else? So created a wealth management firm. So our firm's called MRG Wealth Management, and it focuses on personal CFO services for executives, business owners, and senior professionals. And the whole concept is to first align and work with an individual and understanding what are their values, what truly matters, what truly means something to them, and then flesh out what their vision is. What is the life they want to live, regardless of their job, where they're living, what they're doing today? What is the ideal life? What are they shooting for? And that is the foundation then for financial planning, investments, everything else we do after that. And then as a personal CFO, we integrate, there's 6 critical areas in anyone's financial life, right? So there's financial management, there's retirement planning, there's investments, there's tax, there's risk management and estate. And, we have a team that works together to support our clients on all 6 of those areas. And then there's other professionals that need to be involved. Quite often there'll be an accountant that does, the administrative, accounting filing. Depending on, business owners, we quite often need a lawyer if they need to restructure their business. And we're looking at the operating company or a holding company or maybe a trust, various business transactions in between. So we'll work together and kind of be the quarterback and coordinate all that, but come back to the core financial strategy and plan for our clients. So that's ultimately what we do. And a little longer than 30 seconds.
That's all good.
But hopefully that shares kind of the reason and why and my passion in the industry and why I built the firm and the team to support the clients the way I did.
Yeah, it's more than just investment management. Like I think when some people, and that's the problem with our industry is you'll have people licensed in one specific area. Like, for example, I'm licensed to sell life insurance, right? But then they'll say, oh yeah, like to get clients, they'll start to advertise or market all these other services that they kind of half-assed do. They'll say like, I sell life insurance, but I also do like financial planning, but they're not a CFP. They've never went to school for anything. And it's just kind of like a facade to get you in the door to say like, yeah, let's look at your cash flow management to see how much money we can free up to sell you a large life insurance policy. You know what I mean? And so that's actually a great point that you brought up. Cause I mean, you are you've been in the industry for a long time. Investment management is one of the things you do and you're very knowledgeable about it. But I mean, you also work with clients to work with their end goal in mind. You do wealth management, you do tax planning. Like you're a CPA by background, you're a friggin' accountant by background. I mean, so you have some experience working with numbers. But I guess like that kind of goes into, I guess, the first thing that I want to talk about today, because like life insurance is relatively, I shouldn't say it's relatively simple. Like it still can be complicated. But at the end of the day, all life insurance advisors across Canada are licensed as a life insurance advisor. And the products are made by, a number of different carriers. We have, roughly 30 carriers here in Canada, and the products are all relatively the same, right? So some of them are sold differently, some are structured differently, but like term life insurance from Canada Life is the same as term life insurance from, RBC insurance, right? But with investments, it's like huge. Like you have so many people calling themselves investment advisors or, wealth management or like whatever they want to call it. But there's so many, like even myself, I'm licensed to sell segregated funds, which is a type, I guess, of investment with an insurance wrapper. And personally, I think it's a garbage product. It's garbage, right? Like it's really only applicable for like 5% of the population, usually people that are like very close to estate planning that could pass away in the next 5 to 10 years. They're looking for some of those guarantees, but it's not a great option for the majority of Canadians, right? And so you'll have a lot of insurance advisors like myself, and you'll go to their LinkedIn and they'll call themselves like an insurance and investment specialist. It's like, dude, no, you're not. Like, you know what I mean? You're just like another insurance advisor with these crappy products that you're selling. So I guess like maybe let's start with that is like, and I know we did this before a long time ago, years ago, you kind of showed me like the tiered structure of like, okay, well, this is kind of at the top echelon. And then there's, mutual funds and this license. So maybe like, let's start with that. Like what are all the different types of licenses and types of products that Canadians have access to?
Yeah, it's a great point, Phil. And it's another area where I think a lot of Canadians aren't aware. And really the short answer is a person or advisor can only talk to you and offer you products for which they're licensed to do so.
Yeah.
Right. So, as Phil, you just mentioned, you're licensed on the insurance side. So if you're speaking to an insurance advisor, they can talk or offer insurance products. Right. And from an investment standpoint, you have segregated funds that you've mentioned before. I agree with you. There is a point to them, but it needs to be a fit for purpose. And quite often it's a very small segment of the population that will actually need that fit. And then there's also permanent life insurance, and can be a cash value growing in that as well.
Yep.
The purpose is the insurance advisor can only really talk about, insurance products. So if you're looking to get comprehensive advice and focus on a large rate, the person can only do what they can do. They're legally focused just to be able to offer that. The other option outside insurance is then you go into a mutual fund advisor. So, individuals might have gone to, example, as a bank or someone that used to be part of what's called MFDA, Mutual Fund Dealers Association. And the products they'll offer is all different forms of mutual funds. And the important piece to know is that, what is their license? If they're only licensed for mutual funds, well, don't expect individual stocks or bonds or, insurance. Like, they're a mutual fund agent. They're going to share their knowledge on mutual funds.
Yeah.
So that's a big piece of the industry that a lot of people don't know. They go talk to one person and they think, okay, this person's going to look after their needs and give them the best advice of the whole world. Yeah. And in reality, depending on your license, they're handcuffed to just talk about one thing. And even outside of that, if you have another license, depending on your relationships and even your knowledge varies vastly in this industry. Mm-hmm. So we talked about insurance, we talked about the next level, or one of a different level being mutual funds. There's also a license in Canada called EMD. It's exempt market dealer.
Yeah.
So these individuals can sell exempt market investments, means that they're not usually publicly available. You can't get it on a direct invested account. It's not like a mutual fund. They're usually higher risk, and they're quite often private investments. So you can go to these individuals and they'll share their suite of products or tools and say, hey, this is what I have access to, and give you advice based on that. But they're, again, limited. If you just have that license, that's all you can talk about.
Yeah.
Then another level of licensing in Canada is through IROC, which stands for the Investment Industry Regulatory of Canada. And some of the regulatory body have changed in 2023. So this is going through a bit of a transformation in Canada. Okay. But the nuts and bolts is, if you have a registered representative advising license, now you can start talking about stocks, bonds, ETFs, different funds. So you're like, okay, you got a little more options, but you still are only limited to that area.
Yeah.
And then on the top tier, you're talking about the pyramid. So if we look at the different licensing and what you can provide, one of the top tier licenses in Canada from an investment perspective is a portfolio manager. And a portfolio manager is the only license in Canada that actually has a legal fiduciary duty of care to clients.
What does that mean?
Many people will say, like, they're going to do the best for their clients or look after their clients, and as they should. But just like a doctor or lawyer, part of their profession has a legal duty of care. Once you become a portfolio manager in the investment world, you have a legal duty of care. And so what fiduciary means is just that you have a legal responsibility to act solely in the best interest of the client, right? So you're held to one of the highest standards. Again, doctor and lawyer, accountant, those are all professions that have a fiduciary duty of care. So in that license, now you have access to a wide array of different investment products. You can make investment decisions for individuals that might not be accredited investor. So someone with $500,000 but has the risk profile and wants to be involved in, maybe a specific real estate investment. Mm-hmm. That license would then give the power for the advisor and that client to be able to access those type of investments. Outside of that, you'd have to be an accredited investor.
What does that mean, accredited investor?
Yeah, so an accredited investor means that you meet certain criteria to take on a level of risk with investments. So quite often you'll need to have $1 million of investments, so not real estate or business, like in your investment account, $1 million, family income of over $300,000 or individual income over a set amount. So there's certain criteria that you need to meet to be an accredited investor, and not all Canadians meet those criteria, right? So again, you don't even have access to how high net worth families and institutions are investing because of that as well. So going back to your question though, so those are some examples of your different licensing.
Yeah.
And you don't need to just have one. So for example, my team, we have a portfolio management license. So we have the highest level of investment license in Canada. I'm also an insurance advisor, right? So you link the investments and where it makes sense, you also have insurance. Mm-hmm. And we also are able to act in the exempt market space. Mm-hmm. So depending on the fit, again, investments are a tool. So I call it as an analogy, like if you're building a house, you're going to have different nails and different screws to build your house. There's not one size fits all. It depends on what room in the house and how big is the house and what you need to use. So by having different tools in kind of your toolbox, and that's what, as a personal CFO and a wealth manager, we do, we're able to truly align the different needs our clients have with the different options and products out there.
Yeah. Yeah. So that's yeah. Thank you so much. That's actually a really good point. So like one of the things that I constantly bring up on my channel, and I say this over and over, like I'm a huge Star Wars buff, so I always say only the Sith deal in absolutes, right? So like there's the constant argument back and forth of like a term life insurance versus permanent life insurance, and in my opinion, I think term life insurance is probably the best option for the majority of people. However, using permanent life insurance specifically as an investment can be a good idea for like the high income earners or business owners that are looking to leverage, grow some wealth. They have other assets. They've maybe maxed out, well, they for sure maxed out their TFSA and they've maxed out a large portion of their RSP, and they're looking at some type of supplemental investment or investment strategy at that point. So you brought up all these different licenses, okay? Is there like any type of, because I know one of the things that we talked about, you know, you talked about accredited investors, you talked about people with $500,000 of income. Is there like tiers to finance? And what I mean by this is like, if I come in, I'm a Canadian, I have 50,000 to invest, or I have 150. Is there different levels? Like, is mutual funds like, you know, sometimes a necessary evil for people that are making over or under, pardon me, $100,000, and maybe they don't have access to these portfolio managers and other accredited investments, or is it just kind of like all crap? Like, what's your opinion on that?
Yeah, it's an excellent point, and it's a very subjective answer. So I'll say that up front. Each person might have a different tier structure.
Yeah.
And before jumping into the tier structure, one thing you just mentioned is like, are mutual funds a necessary evil? I think it's a common misconception out there as well that, you know, mutual funds are bad or an RSP is bad. You know, it's like saying a bucket or a blank piece of paper is bad, right?
Yeah.
Really, that we can't paint one thing with a brush of everything. So a mutual fund is just a trust where you put a bunch of investments inside, and the owners and the different holders of the trust participate in what's happening, right? Yep. So there are fantastic different mutual funds out there, and there are some that are not great, right? So it's not a good versus bad. Same thing as RSP. Sometimes I'll hear individuals be like, well, you know, should I invest in the RSP or this? And they treat it more like the RSP is an investment.
Yeah,
and
for sure.
Just to clarify, the RSP
is just an account.
It's just an account. It's just like a bucket, right? So it stands for Registered Retirement Savings Plan, and it has a different tax implication than another account, for example, like a TFSA that just stands for Tax-Free Savings Account.
Yeah.
What you put into those buckets can be the exact same thing. They can be different things, you know. So it is just a bucket. So it's not like an RSP or this account is good or bad. It's just a bucket for tax. And then what type of investments are you putting in those to do what you want to do, right? So I just wanted to clarify that, because sometimes that's a big misconception. So from a tier perspective, going back to your question though, Phil, quite often what we see, and again, there's no, I wouldn't say one size fits all. So I am going to just generalize to answer your question.
With an asterisk,
really depends, on the age, the individual's income earnings, like risk, number of variables will go in there. But I'd say when someone's, starting out and they're focused on their financial journey and say, hey, you know what, I got my job, I want to start paying myself first. And paying yourself first just means like out of every paycheck, keep a little back. Right? Like it kind of an old adage is don't just always spend what you make, keep a little about, invest it, and have your money start earning money. Yeah. So when you're starting out, what I'd recommend is seek someone smarter than you, right? No matter how smart you are, there's always someone smarter out there. So when you're starting out, seek someone that's smarter than you with a small financial nest egg. Quite often, you won't have access to some of the more top tier portfolio managers or wealth managers out there, just from a profitability standpoint, right? A lot of people would love to help everybody, but you can only help out so many people. And, when you're starting out, quite often you're not willing to pay, large values of sums for their advice. So if someone was 30 years old and wanted to do a financial plan and went to someone and said, okay, it's going to cost you $10,000 to do a financial plan, but the person said, well, I only have $5,000 to invest. Like there might be a misalignment between, the value provided and the cost. So the first tier is find someone smarter than yourself. I think the banks do a reasonable job of this. Again, each bank, each advisor who you're going to talk to could vary drastically. But the point is, the banks offer the service to generally all their clients. So if you come in with $1,000 and say, hey, I want some help setting up an investment account. I have some questions I want answers to. Where should I invest? And at this point, it's really just starting down the journey of figuring out, okay, how do you develop a financial plan, develop a financial strategy, talk about budgeting, and set up the behavior for consistent savings and growth, That's the most important thing here. And then of course, managing your risk. Try not to just, pick it yourself and be like, okay, this month I'm going to pick this stock because, someone on YouTube or someone in the news or the media or my friend or my mom or whatever told me that this is the pick of the month.
Yeah.
You don't want to lose your money. You want to grow it, right? And you want to have a system in place to do that. So quite often mutual funds is what the banks, from what I will see in different individuals, what they'll offer, right? It's an opportunity for people to get a varied amount of investments. So for example, if you had $1,000 and say, okay, I want to have exposure in Canada, the States, and Europe. Well, you can't just start buying 50 stocks with $1,000. It just doesn't work.
Yeah.
So a mutual fund, again, just that pooled kind of trust could be a great option for them. And it also spreads out the risk where they can still have exposure to multitude of different companies in different industries in different countries as they grow. So that's kind of usually the first point where I find a lot of people, go in the tier.
Yeah.
The do-it-yourself investor is also, very popular in this stage.
Yeah, I'd love to talk about that because that's actually like a large thing. I mean, like Quest Trade and Wealthsimple and these other institutions have been doing a massive marketing over the last 5-10 years on fees for, from the advisor. I mean, a typical MER, management expense ratio could be 2%, 2.5%, 3%. And we're starting to come into this age now and they run, tons of ads saying like, well, here's what your portfolio just cost you, right? Going with an advisor. And what I find as well quite a bit is like advisors that literally do nothing. They'll throw their clients into, you have 50 grand or 100 grand. Okay, well, DSC this, meaning that if you take the money out, you have to pay. And then I'll just make my commission on it. And I offer nothing for it. And then you have, on the flip side, these do-it-yourself options, Wealthsimple and Quest Trade. So like, I'd love to get your opinion on that. Like, do you think that these, you mentioned going to the bank with $1,000, but do you think that these institutions now, this like bottom of the rung, I don't want to say bottom of the rung, but you know what I mean? Bottom of the rung institutions that are kind of dealing with, low investments and they don't have high, as sophisticated of products. Do you think they're really going to get overtaken now by these do-it-yourself institutions that just have way less MER?
I think it's going to be a mix, and I think it's going to depend on the situation and what someone wants. If someone's very comfortable with spending hours a week doing research, if they're comfortable building and learning how to diversify a portfolio, exploring the different investment options, if they have maybe someone in the family that is in, has experience in investing, all these factors come in. I think there is definitely a place for starting out in the do-it-yourself brokerage houses and things like that.
Yeah.
I think I've also seen and heard of numerous cases where, the fees are lower because you're taking all the responsibility, but the risk is also a lot higher. So, not having a system in place to figure out how are you going to manage your financial future, and not just from the investment side, but the overall planning, the tax, aligning with your values and goals, that's quite often missing. So I think one of the interesting marketing aspects in the last decade has been all the marketing on low fee, low cost.
Yeah.
And I don't know if the public fully understands is in the investment industry, you can't advertise returns. I can't say, hey, come with me because you're like the last year I made my clients X.
Yeah.
And all of a sudden, it's important to understand what the fee is, but ultimately people want to make money.
It doesn't matter if they're making money.
Yeah, if you're making more money after fees, the ad would quickly be like, well, I want to make the more money after fees with this person.
Yeah.
But you can't say it. You can't advertise performance to the mass.
Why is that? Why can't you do that? Is it just like because there could be predatory marketing practices, or like, because I know like we've spoken off camera and I know that you guys kill it when it comes to returns, but you can't advertise it. And I feel like that would be a huge driver of business if you could be like, hey, this is what we do for our clients. It's huge. Right? Like,
absolutely. It would destroy a lot of those low fee ads.
Yeah.
And the biggest challenge is suitability. So, a true professional doesn't say, hey, everybody in Canada buy product A and it's going to fix your, needs.
Yeah.
I don't know until I actually meet you. And any professional, like, a doctor shouldn't be going out there and say, hey, everyone take drug X. It's going to make you better.
Yeah.
Well, no, like what's the problem? And then let's fit the solution to the problem. So suitability is the big thing. Gotcha. Understanding, risk tolerance, understanding what the person even wants in their life. Are they 75 years old and they just want really low cost income coming in? or are they 40 years old and want to focus on growth so that they can, achieve a retirement goal?
Yeah.
Everybody's different. And a true professional treats everybody different. So the industry looks at that and says, you know what, we can't be advertising returns, because how do you know that product's even a fit for the individual on the other end, right? Like if you put it on a TV commercial, who's watching that TV commercial?
Yeah. Yeah.
So that's one reason. There's a few other reasons as well, but
that's
suitability and risk, that's one area. So from a fee perspective, though, you're allowed to advertise fees. So if you can advertise the return side, the next best thing to advertise, and it's done the low cost kind of do-it-yourself firms very well, is let's advertise on the fees. Because if someone can't see the returns, they can only see the fees, then let's go with the lowest fee. Makes sense. But not telling the full story.
It's a little bit deceptive in its practice and its marketing.
Understanding the full story is what I think clients should be looking for. And fees are important. You pay for quality advice, and if you're paying for something in any industry and you're not getting the value for what you're paying, you should always reevaluate what you're doing. Right? So I think that's important, but I think it's also important to know that quality costs money, right? An example sometimes I'll use is you could probably go on YouTube and figure out how to do a root canal, right? Buy a couple tools, rip some teeth out. You can screw up your nerves in your mouth, create a lot of pain. How many people go do that, right? You're going to pay a dentist. They spent years perfecting their craft, their trade, and build out a business to be able to do something to solve one of your problems. So go do that. In the investment industry, it's no different. There's a big difference between sales agents and true professionals. So align yourself with a professional that supports individuals that solve your problem. People have different problems and different needs. Our industry is no different. You need to align yourself with a professional that has experience and value in doing exactly what you want. And then I think there can be a lot of value for you in there.
Yeah. Let me ask you this question here. And we've talked about this before. And I've talked about it with you, and I've talked about it with other portfolio managers as well. Where is that sweet spot? Whether you do it yourself with like Wealthsimple or Quest Trade, or you go to a bank and you're buying mutual funds, or you go to some IROC dealer and you're starting to get some stocks. When's the sweet spot? Because like we've talked quite extensively, and I know your firm does fantastic work, and I've talked to other portfolio managers as well. They do really good work as well. What's the sweet spot to be like, okay, I've gotten my income and my investable assets up to the point now where I can get on as one of those clients?
Yeah, I think there's two sweet spots really. One is kind of at the $250,000 mark. So usually quite often individuals, the first, 0 to $250,000, you're building out your savings habits, and they'll either maybe be at their bank or sometimes the do-it-yourself kind of investment firms. At a $250,000, it's a really important time to just take a pause and say, okay, is there someone better for me right now? Is there an independent advisor that, works with individuals like me in my income bracket, my industry, my needs, my problems, and we can start building out more of a strategy than just the investment side. And, and what am I doing going to get me where I want to go? So I think that's the first kind of point. At a $250,000, you'll start having some different options for different advisors, but you may not get your top tier advisor. The next point is at $500,000. At $500,000 now, kind of depending on your age, your registered accounts are starting to get, maximized or pretty close. Taxes come into more of a play. Other risk tolerances and other investments you're wondering about, and you're looking for quite often more holistic advice on, again, taking that stage and just broadening it out. So $500,000, and again, it opens up to new advisors. So for example, with our firm, that is our client minimum is $500,000 of investable assets for the household. And it's because those type of individuals, have the investments to be able to diversify the way that we build, but they also have the problems that we solve. Right, so they're getting into those tax, those complexity. Our business owner clients, they're expanding their business. We're looking at corporate restructuring. Our senior professionals and executives have challenges, and we focus on solutions for those challenges that we see day in, day out. So that's kind of the next tier in level that I would say, really to start reevaluating where you're going and who do you need supporting you on that journey.
Yeah, you brought up a really good point there, because I really do think that like investment management is just one tiny component. I think people get very caught up on just the percentage. Like, how much did I get back? Was it 5%, 6%, or 7%? But then like they don't realize that especially if they're high income earners, there's so many other variables that can come into play with planning. Tax planning, are they optimizing their RSP and their TFSA? Are they doing, corporate planning or anything like that? Like, there's so much more planning that can add so much more value to their overall wealth and overall retirement plan and whatever they want to do. And I think that sometimes gets missed because it's just like, percentage. I want to see the returns. I want to see all the numbers. What did it exactly do? And I think in being so focused on that return, you miss out on so much of that other value.
100%. And ultimately, what does the percentage give you other than peace of mind for that second that, like, oh, you beat the benchmark by X or you didn't, whatever that, target is. Ultimately, are you trying to beat a benchmark or get a return, or are you trying to achieve something?
Yeah.
So is that percentage that you got this year, when I ask people, they're like, okay, are you on track to go where you want to go?
Yeah.
And quite often the answer is, I don't know.
I don't even know where I'm going.
I got X percentage last year. I got X percentage this year. Here's the dollar of my accounts. Is this good or bad? It's like, well, where are you driving to? Like, this is where you're at. Okay, so we have a starting point, but where are you driving? Like, what map are you using? Where's your end destination? And that's usually the biggest thing that's missed. Is, people get so busy with their life, with their job, with their family, with all these other things going on in their life, and they don't have the time. And quite frankly, unless you've spent, 30 years, let's call it many years, in the financial world and dealing with a full team of individuals supporting it, how do you have the knowledge and tools to do it? I work with numerous individuals to support my team. I have 5 different financial degrees. I'm learning something new every day. And there's no way I could do just by myself to support all my clients. Like, it takes kind of a village and a full team of professionals that have experience in different areas and different value propositions for our clients to be able to deliver the results that we do. I'd say number one is that value and visions drive of where you're going. And then the second piece is, once you understand your return for the year, is map that out. Like, always look at projections and say, okay, where is that taking me? And is that going to get me to where I want to go? And the big thing is, if not, what are my options? What do I need to do, or what can I do to ultimately, at the end of the day, whether it's retirement or legacy or a new house or that, fancy car or trip or whatever your bucket list or goal is, what do you need to do to get there? That's truly the value. And you also mentioned tax. Tax is usually one of the things that's always missed in individuals. And, I'll ask an individual, you'll be sitting down and we're talking about tax, especially once your registered accounts are maximized out. You're paying large taxes on your investment growth. So a high income earner in Canada will pay roughly 50% tax on what they make. So
it's huge.
It's huge. It's like
crazy.
Half of everything you have. So that percentage that you beat the benchmark, great. Now take it in half.
Seriously.
So if you got, let's say, 7%, you lost half. It's 3.5. It's like, well, wait, that's not good. Inflation's a lot higher than that. Like, I'm actually losing money here. Okay, well, what
we got to do a little bit more planning.
8%, but only paid 25% tax, or a much smaller tax rate. So let's look at the after tax rate that's actually going in your pockets. All these things are really important to consider than just the upfront, or what stock's the best to invest in, or those type of pieces.
No, that makes sense. The last two things that I just want to talk about here, and I think you'll have some good insights into this, is just like, what are some common sales tactics on the investment side to avoid? So in the insurance side, it's like, I mean, you'll know this because you're also insurance licensed, but we have a lot of MLMs in Canada. I don't want to name any names. We have a lot of MLMs that really focus on selling permanent life insurance, whether that be whole life insurance or universal life insurance. And there is a heavy emphasis on universal life insurance to the wrong type of client, to low to middle income earners. Like 70% of Canadians are under $80,000 per year, and they're selling these type of permanent life insurance policies to them of like any amount. And I really don't agree with those practices. So like, that's one in the insurance industry. And I made another video where I talked about like some ways you can fact check your advisor. We have a life insurance in Canada here, Facebook page where it's just like 3,000 advisors. And I thought like, hey, if you post that question in there, on the Facebook page, if like this is what the advisor is pitching me, you're going to get a bunch of other advice saying, no, this is a bad idea. So on the investment side of it, what do you see? Like, I know leveraging for improper clients is a big one, but what are you seeing as some of the improper sales tactics in the investment side? And what are some ways that they can fact check it or try and avoid it?
Yeah, so I think some things to be cautious of.
Yep.
If someone's pitching you something, red flag. Right? Like pitching anything, whether it be insurance, investments, this product, like that's sales. Like, so what are you looking for? Are you looking for a product to buy? Are you looking for a commission salesperson? Or are you truly looking for a trusted professional to help you with a problem? Right? So figure that out. Right?
Yep.
And if you are just looking for a product, well, then go kick a bunch of tires and they're just going to throw you different pitches and, go down that path.
Yep.
I don't recommend it. And I don't feel most people are looking for products or pitches. What they're really looking for is solutions to problems that they have.
Yep.
So if you're going and looking for a solution to a problem, no different than if you went to your doctor and you walk in your doctor's office and before you said like, oh, I think I broke my leg, they're like, hey, here's 4 drugs, try them, get back to me. How would you feel about the trust? You're like, well, doc, I didn't even tell you. It's not my head that hurts, it's my leg I think I broke.
Yeah.
In the investment world, it's no different. Like, understand and align yourself with someone that is truly there to solve the problem that you have. And to solve the problem, you and that individual need to understand and clarify exactly what that problem is. So clear expectations on both sides. So in my experience, those are some of the best relationships and what I'd recommend Canadians to look for. Like to first, self-explore and be like, okay, what do I want? What am I frustrated? What am I vulnerable? What do I need? You might not have all the answers, but do some reflection on, again, like even just what are your values and goals? What do you want in life? Bring some of those to a true professional and then have the conversation around, okay, here's the challenges that I know of, and look for the professional's feedback on giving their advice because they are professionals in the industry. They should be able to really uncover the vulnerabilities and opportunities you have that you might not see yourself, right? So that's what I would say to look for, and you're going to have a better chance of success when you start the conversation solving a problem than focusing on product. The product at the end is just the tool that helps you along the way. Again, you build in a house. Do you start with picking the nail and screw you're going to use, or do you start building out the blueprints and working with the architecture to figure out, okay, I want a 2-story or 3-story or bungalow or this big? Like all those are way more important than the 2-inch nail you're going to use. Nail you need to use to hammer it in the wall, right? Yeah. So that's a starting point. Some of the things maybe to be cautious of would be if someone's just pitching products, first meeting, and they're like, okay, move all your money over. Here's 5 products. This is going to solve all your problems. Products aren't going to solve the problems. They're just tools. Another one, you mentioned leverage. A lot of individuals will focus on returns and growth and all the positives. There's no free lunch. They're like, unless you're invested just in a savings account and a GIC, and even those have a small amount of risk to them, everything else has risk, right? And you have to be prepared for the loss of what you're investing. That's why it's called investing. You're putting money in, goal is to grow it, but you're willing to take some risk. Yeah. And being really clear with what risk you're willing to be able to take. Are you willing to lose it all? Are you willing to lose a little bit of it? Are you willing to lose it all overnight? Or, understand and talk back and forth with these professionals, because there's risks in everything. Yeah. Even in the bond market, which, bonds are traditionally classified as low risk. Last year was one of the worst bond years in decades. And, many individuals invested in bonds lost double digits. Right. So for a low risk investment, if you have $1 million invested in bonds, just in, a bond, Canadian bond index ETF, you could have lost over 100 grand. Right. Yeah. So there's always risk when you look at market fluctuations over the last 100 years. The last 5 largest market corrections, we use the US because they have about half of the global stock market right now. Markets dropped 50%, and it took over 10 years to recover. Right. So if you look at over the last 100 years, the 5 biggest market crashes, there was a sizable recorrection of wealth. And over time, diversified portfolios have gone back up. But people, I think, sometimes forget that there is risk to all of these investments. And do I fully understand the risks I'm taking on? What could go wrong? Mm-hmm. Right. So understand the positives, but also always the negatives, and build out a strategy that aligns with you. Leverage, you mentioned, no different. There can be a point, potentially, depending on the person, if leverage makes sense. For many individuals, it doesn't make sense, right? Again, unless you have the capacity to lose a lot of money and repay back the debt you took on.
Yeah.
What is your plan for if something really bad happens? And it might be no fault of the advisor or the industry. Like when you look at major market corrections, the whole market drops. You look at the .com or the 2000 market crash, right? That was a lot of tech companies that led it, but the whole market dropped. Coronavirus, in 2020, that was a very short-lived market correction, but you saw all different industries and countries start going down in price and valuations and stock prices. So luckily that recovered in a very quick amount of time, but it might not
always the case.
Not always the case, right? So, I would caution you to look at that. We're coming out of, the last, 10 years, really since the financial crisis in 2008, markets and investments have been fairly positive, looking at from a market perspective like Canada, US, Europe, and people have been making some good money. But it also creates sometimes complacency, being like, okay, the last, number of years I was getting double digits positive, life is good. When you look at, again, the last 100 years, that is not normal. And, if you're making a lot, double digits in 1 year, well, it corrects back down in other years.
Yeah.
And the thing is, you don't know the timing. There's no advisor out there that I've ever met and think I'll ever meet that says, I can predict the future. I know exactly when the next market crash will be. Yeah. I know exactly what the next company, industry, sector is going to take off.
Yeah, except for Bernie Madoff.
Right. So it's, that'd be another thing to watch out for.
It's Bernie Madoff.
Someone would be like, hey, invest in this. It's a sure thing.
Yeah. Don't look at it. I have no documents for you.
So always risks with everything you do, and to understand those risks. Those are the commercials I wish, people would more talk about. Yeah. Fees are important. That's a quick conversation. It's like going to the grocery store. You're holding up some bread, costs $5. Well, is this bread worth $5 to me? And you make the decision, yes or no. Fees for financial advice is the same thing. Should be very transparent. This is what's going to cost you. This is what you're going to pay. This is what you're going to get. And then you make a decision. Is that worth it or not? Once you make that decision, you move on.
Yeah.
But the risk and all those other aspects, they don't move on. They carry forward. Every single different investment has a different risk profile. And the combination of the investments and how it fits into your overall strategy, again, changes as you change. So those are the conversation I think that is really important to pay attention to.
Yeah. Dude, well, listen, thank you so much for doing this for me. I really, really appreciate it. If anyone wants to connect with you or find you, do you have a website or LinkedIn or anything like that? What would be the best way?
Yeah, absolutely. So our website, mrgwealth.com. It's got a wealth of information in there, no pun intended. But one of the first things you'll see on the website is you can join our community. So I send out one impactful email a month. It's not for spam or anything else. It's actually about sharing true knowledge that adds value to individuals. So I'd say if anyone's looking at furthering their financial literacy and knowledge, sign up for that kind of monthly publication and share feedback. So it comes directly from my email account. You can reply to it, share me feedback, what you liked, what you didn't like. If you have a challenge or problem that you want to see featured in one of those, let me know and I'll have me and my team start working on it. And then if you want some support with your financial journey, if you're looking for a financial advisor or a personal CFO, by all means, please reach out on the website. You can connect with us. You can schedule a meeting directly with me. It's linked to my calendar and would be happy to have a conversation.
Awesome. Thanks so much, man.
Thank you, Phil.